In this video, we will discuss inflation, target retirement date funds, and interest rate risk. My name is Cundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently an adjunct professor of accounting and financial management at the University of Maryland's Global Campus. Also, I work as a retirement strategist and a portfolio analyst. Target date funds were originally designed in the early 1990s by Donald Luskin and Larry Tint of Wells Fargo Investment Advisors, but they didn't really catch on until after 2006 when the Pension Protection Act was passed. This act allowed for auto-enrollment of target date funds into defined contribution plans and set the stage for qualified default investment alternatives. So these became then the default investment for many, if not most, 401k and 403b plans provided by employers. What kind of investments qualify under the Pension Protection Act as qualified default investment alternatives? Well, an investment service that allocates contributions among existing plan options to provide an asset mix that takes into account the individual's age or retirement date. And this can be one that's professionally managed, or in the case of a target date fund, one that is automatic based on the age of the individual investors. They could also include things like balanced funds that take into account the characteristics of the entire group of employees. So we can see at the graph here, again, the PPA was passed in 2006. Around 2008, only 20% of retirement plan participants held a single target date fund. This has been increasing gradually since then, and as of 2022, it's close to 80% of investments in retirement accounts hold a target date fund. So a huge increase in participation. Why are these so popular? Well, a lot of people don't pay attention to their retirement accounts, their 401k, their 403b, provided by their employer, and their employer, of course, doesn't really want to get sued if something goes wrong, and qualified default investment alternatives are considered a safe harbor, i.e. that relieves the employer from the liability should the QDIA suffer investment losses. So before the PPA was passed in 2006, when an employee started participation in one of these retirement accounts, generally the default was a money market fund where money just sat there and earned a small amount of interest and wasn't invested in stocks or any sort of a more risky retirement account. Since 2006, the default has been the target date funds. So for people who don't pay attention to their investments, this may have been an improvement. It's probably better off for them to be in a target date fund than a money market fund. But as we'll see, target date funds have significant interest rate risk associated with them, and the bond components generally over time lose money. TIAA-CREF is one of the most popular managers of money for academic institutions, and this is an example of their target date fund, one of them the Lifecycle Index 2025 fund, designed for people who will be retiring in the near future in 2025. So as we will see, this fund has a higher percentage of bonds than those people who are retiring at a later date. If we look at the components of this fund, the first one listed is an equity fund, largely U.S. stock fund, with around 40% of holdings, followed by a bond fund with 35% of holdings, an international equity fund with 11% of holdings, and an emerging markets fund with around 6% of holdings, and then two more bond funds, one that is inflation-linked with 4.36% of holdings, and one that is a short-term bond fund with 4.36% of holdings. So the total bonds in this is around 45%. At least 40% or so of them are longer-term bonds, and then around 4% short-term bonds. So this is a lot larger bond holding than, for example, the previous default if somebody wasn't paying attention and they just went into a money market, which would be short-term debt. Why might the government like people to invest in these? Well, somebody needs to buy their debt. It's up around 30 trillion now and continuously increasing. And of course, this sort of a system with target date funds strongly encourages individual Americans to invest a large fraction of their retirement money in U.S. government debt. We can see a graph here of who owns U.S. government debt. Top is the Federal Reserve. The bottom two are U.S. trusts, such as the Social Security system and other government pension funds, and the very bottom is foreign holdings. So you can see that individual investors in the United States aren't terribly large holders of U.S. government debt. The yellow section in there is U.S. institutional individual investors, and at least the target date funds encourages individuals to buy into government bonds, and that's probably a very significant component of the yellow line here. So how exactly do these target date funds work? This is the Vanguard Target Retirement Date Fund allocations from those retiring in 2060 to those deep in retirement, which is the target. And you can see with the 2060 fund, it is majority in their total stock market index, which is the Wilshire 5000, invests in basically the entire United States market, followed by another large fraction of investment in the total international stock fund, and then a pretty small fraction in bonds, just around 10%, the majority of those being domestic bonds and the remaining being foreign bonds in red. As you approach retirement, the amount of money invested in stocks decreases significantly, and the amount invested in bonds goes up significantly. So by the retirement dates here in the 2020, you're roughly approaching 50% bonds, and the target deep in retirement, you are majority bonds. Why could there be a problem with this? Well, these funds were designed again in the 1990s. In the 1990s, at least there were higher interest rates. This is the short-term Fed funds rate. We'll look at the 10-year rate later, but at least you were getting interest rates 5, maybe 7% on your debt investments, and that was probably above inflation, depends on how it's calculated, so you were actually making some money off of your fixed income investments. Whereas today, as you can see over in 2020, well, the Fed funds rate is 0. We'll show later the 10-year rate is around 2, which is well below the inflation rate. So all of your fixed income investments, the buying power of them goes down every year, and they pretty much guarantee you a loss, at least with inflation. So what might have been a good idea in the 90s looks pretty questionable as an investment system in the 2020s. Here we have again the yield curve written out for U.S. government debt, ranging from 3-month debt to 30-year debt. 3-month debt, 0.34%, basically nothing. By the time you're up to 12-month debt, locking your money up for a year, you at least get a little over 1%. And for a 30-year investment, locking your money up for 30 years, you get 2.25 or 2.27%. But the inflation rate is much higher than that. The bottom line in red is the official U.S. government's inflation, whereas they're now claiming it's around 7%. So if you're in a 30-year government bond paying 2% and inflation is 7%, your buying power is going down by 5% every year. And as you stay in retirement year after year after year, you can buy less and less and less. The people at Shadow Stats don't believe the U.S. government is honest in its inflation calculations, and they try and calculate inflation the way it was before all of the changes in the 80s and 90s. They believe the US inflation is now over 15%. Well, if that's the case, your buying power is going down by around 13% every year if you're invested in US government long-term debt. And pretty quickly you will have a lot of problems paying your bills. So how do bond prices behave with interest rates? Well, if we look at the very bottom here, we see present value, which would be the price of the bond, equals the payment, which would be a coupon payment of the bond, over 1 plus the interest rate in the market. And for the payment occurring in 1 year, this is 1 plus I to the first. If it occurs in 2 years, it's squared, 3 years, it's cubed. And final going out to however many years, it's to the n power, maybe 30. Well, as that interest rate at the bottom, the I goes up. As you can see, the PV goes down. So not only could your bond be losing your money by the fact that the coupon rate now is below the inflation rate, if we get an interest rate spike with the market perceiving inflation, or with the Federal Reserve cutting down on quantitative easing or raising the Fed funds rate on the short-term side, and this results that should help with inflation, but may not. Anyway, if interest rates go up, the price of the bonds will go down, and not only will you lose buying power as your payments are below inflation, but the value of your bonds themselves can sink significantly. So the graph we put up earlier was the overnight Fed funds rate. Here is the 10-year rate. And again, we can see if we go back to the 90s when target date funds were first proposed, we had interest rates of 7.5%, and now they're below 2.5%, again, well below the inflation rate. So if the Fed cuts down on quantitative easing, or if the markets adjust to the high inflation rate and interest rates go up, how will this affect the target retirement funds? And again, we will look at a duration 2025 fund, the Vanguard Target Retirement 2025 Fund, VTTVX, which at the point I looked up here had a yield of 1.52% and was invested 41% in bonds with an average duration of 7 years. Duration is a measurement of both the sensitivity of the price of the bonds changing with interest rate changes, and it's sort of basically an average time period if it takes you to get your money back. So bonds pay coupons. A 10-year bond, you're going to get your money back quicker than 10 years because you get part of it back in coupons. But on average, it would take you 7 years to get your money back investing in the bonds in this fund. So the formula for the change in percentage price of the bonds is the delta PV over PV. That's the change in the price of the bond over the price of the bond, or a percentage change in the bond. And that equals minus the duration times the change in interest rate, at least for parallel shifts of the yield curve. If you want to look at this in more detail, I have other videos that cover this and the concepts of duration in quite a bit of detail. So in this case, our duration is 7.03 years. Let's consider a small increase of interest rates of only 0.5%. Well, this would mean that the bonds in your fund would lose 3.5% of their value. This has happened this year, so that's a pretty easy thing to see. The fund is 41% bonds, so that means a 0.5% increase in interest rates will decrease the value of your fund by 1.44%. What about a really significant inflation-related interest rate spike like we saw in the 1970s of 10%? Well, then the value of your bonds in this fund would drop by 70%. The majority of the value would be wiped out, which with significant inflation in the economy is certainly a possibility. How have target funds behaved so far year to date in 2022? Well, we can see they've all dropped in value, and this is due to interest rates going up and also due to stocks dropping. In general, the longer target retirement funds dropped more than the short-term ones, as would be expected with an interest rate or with a stock market drop. So the longest one lost 7.5%, the shortest one lost 4.4%. To some extent, this is working the way it's supposed to because people in retirement at least aren't losing as much money. Now let's look at the performance of the individual components of Vanguard's Target 2020 Fund. So far, year to date, they have all lost money. The biggest losses have been in the light blue line here, down around 9%, and that is the total stock market index fund. The stock market has dropped somewhat in the United States, so that would be expected. The second biggest loss here of around 4%, though, is in the total bond fund. That is just to a small increase in interest rates, as the Fed has indicated that it will cut down on its long-term bond buying program, quantitative easing. So bonds that are supposed to lower volatility in the fund have actually been pretty volatile. The least loss up here of only 0.7% is from the inflation-protected bonds, which didn't go down as much since the CPI went up significantly. If we look at those same components longer term, we see that basically all of the bond components either lose money or make less than inflation. So investing in bonds may cut down on the volatility of your investment, but it's pretty much guaranteed to lose you in buying power over time. On the other hand, stock markets are very volatile. You can see here the total index fund, total U.S. stock market index funds around up 80% over 5 years. And also VGTSX, which is the international index fund, is up around 27%. Over this century, since the Fed was created in 1913, the US dollar has lost around 99% or more of its buying power, and this is just going to accelerate as the Fed keeps printing more and more money to finance the US government debt. So if long-term bonds are now high risk and no longer a good deal, how should one adjust one's target retirement funds? Over time, keeping the stock components is probably a good idea, although the U.S. stock market also is probably overvalued over time. Those will make you money. Well, what are your alternatives for fixed income? Well, you could just go to basically only taking on inflation risk, no interest rate risk, and go to cash. You could go to very short-term debt instruments, which are not going to lose as much money with an interest rate spike. You could go with something like gold, which at least will probably keep up with inflation and probably perform better than bonds. Other options might be high dividend stock funds. Vanguard has VYM, which is a domestic high dividend stock fund, and VYMI, which is an international high dividend stock fund. REITs, Real Estate Investment Trust, owning real estate that pays a dividend out associated with rent payments. V&Q through Vanguard is also an option. And then there are more speculative things that might keep up with inflation over the long run but are highly volatile, like Bitcoin. Now let's look at some possible alternatives to the bond investments. Well, we've listed a whole group of them up here. The one year to date that has performed the worst, losing 13% of your money, has been the real estate fund. The best performance so far has been gold. The other ones have been relatively stable, and they haven't been too much more volatile than the one right here, which is the bond fund. So at least these seem like reasonable, stable alternatives at the moment, with the exception of real estate. Longer term, looking over 5 years, again, our bond fund down here is making less than inflation, so losing us money in buying power. Our best investment over the last 5 years with some volatility has been gold, followed by the domestic high dividend fund, then followed by real estate, and followed by the international high dividend fund. Riskalyze does a mathematical analysis of the performance of various investments over roughly the last 20 years. Their data set doesn't go back much farther than that and gives a risk number. Here we see the components again of Vanguard's 2020 fund, with the top component here being the 30% in the total bond market fund, followed by 27% in stocks. This is for the 2020 fund, basically people that are already retired, that again they want to have heavily in bonds, followed by total international stocks of 19%, total bond index investor international now of 13, and then short-term inflation protected of around 10, and a very small component here in total international bond fund. This is given a risk number of 45, where 100 is the maximum risk, and 1 is basically no risk, like a cash account. They also give it a grade, a letter grade out of 4.0, pretty good 3.8, annual expected return of 5.18, and an annual dividend of 2.31. So we'll see how this risk analysis compares with if we take out the components that we think are going to lose us money with inflation, i.e. in particular our bond funds. We can also do a stress test on this and see how particularly the bond components have performed. Again, Riskalyze only goes back around 20 years, so this doesn't include periods of huge interest rate spikes like the 1970s, but there was a small interest rate spike in 2013, and during that time period we can see what happened is the bonds lost 5.1%. Intermediate bonds here lost around 2.8%, and then some of our alternatives as far as fixed income, real estate, preferred stock went up, and the total retirement fund still went up due to its stock components. So this is a example of what could happen to bond funds, only a -7% here, which compared to what you would see in high interest rate spikes like the 1970s, -7 is actually pretty small. What if we convert to cash? Well, going from bonds to cash doesn't really change the risk number that much. So we go to a retirement account that has the same as the 2020 fund of a 28% in total stock market, 19% in international stock market, and then a full 53% in cash. We only get an annual dividend of a little under 1%. The risk number is at 46, and the Riskalyze GPA is down at 3.5. This is one option. It's an option that's going to lose you money over time with inflation, but you won't be subject to the interest rate risk of a huge spike in the case of the Fed ending quantitative easing and long-term rates going up. Another alternative is we could still invest in bonds, but rather than having a duration of 7 years, we will stick all the bonds in short-term inflation-protected securities. So 50% in that. The risk number still didn't change that much. 44, we get a very good GPA, and we get a dividend that's pretty high of 3.25%. So this looks quite good. It seems like a better alternative to the standard Vanguard Target Retirement 2020 with the long-term bond risk. We could also combine in our fixed income alternatives. So here I've shown a mishmash example. Again, we keep the total stock component at 28% and the international component of 19%, but we throw in things like the short-term inflation-protected securities at 20%. We do 6% gold, 6% Vanguard high dividend yield, 6% Vanguard International High Dividend Yield, and 5% mortgages. And the risk number doesn't go up that much, 53, and we get an annual dividend up to 2.4%. Again, this looks like a better alternative than the standard Vanguard Target 2020 with the U.S. government bonds in it. Just like TIAA-CREF and the Vanguard, the U.S. government, for its own employees in the so-called TSP Fund, Thrift Savings Plan, has life cycle funds called L Funds. And this is a split up showing how the U.S. government invests the money for its own employees in the life cycle funds. So again, on the end here, we have people retiring in 2025 and sort of their long-term target in retirement, going up for people to retiring in 2030, 2035, 2050, and the farthest out, the 2065 fund. So young people with a long distance to retirement have 49% of their money in the C fund or common stock fund, 16% in the S fund are the small stock funds, so this is the S&P 500, and these would include stocks that are in the Wilshire 5000 are the Russell, and the I fund 35% in international stocks, and then just a tiny amount here in the fixed income fund, which is the longer term bond fund. As they approach retirement, we'll get all the way here to the 2020 fund, they decrease the international fund to 17, the small cap to 6, the common to 25, and the F fund only goes up to 6%. So the U.S. government is not investing very much of its employees' retirement money in long-term U.S. government bonds. Instead, most of it is in the G fund, which is a short-term money market fund, basically a cash account, and their target is 72%. So for whatever reason, the U.S. government seems to agree with my analysis for their own employees and is not taking on the fixed income risk of investing in bonds. Of course, employees of the U.S. government do have an advantage over those of us who have to invest in a regular money market fund. The G fund does not invest in the same basically 0% interest debt that we do. By law, the G fund must be invested in non-marketable U.S. Treasury securities specifically issued to the TSP. And the G fund investments are kept by electronic entries which do not involve any transaction costs to the TSP. And the fund interest rate is set once a month. So this is the same rate used in other government programs such as the Social Security and Medicare Trust Funds and the Civil Service Retirement and Disability Fund. Well, if we look at the rates of return recently on the G fund, they're pretty good. For 1 year, they got 1.5%. They're still going to be losing money with inflation, but it's a lot more money than you or I would get investing in just a money market fund that has no risk. It's more like a, multi-year, maybe up to 15-year risk fund. So in a sense, at least at the moment, the U.S. government is subsidizing, at least when corrected to risk, the rate of return of their employees' retirement system. Here is a list of some of my sources of information and places for further reading about target retirement funds. These, of course, include Vanguard.com, TIAA.org, and the U.S. government's TSP.gov. If you have enjoyed this video and would like to look at my other videos, I have a YouTube channel, and I strongly urge you to subscribe to it. It really helps me if you hit the big red button here, and it will make it easier for you to find my videos in the future. If you are interested in financial planning services, I offer both money management and fee-only planning with a minimum investment of $100,000. You can contact me on my LinkedIn profile under linkedin.com, Cundiff. I thank you for watching this video.